question has been echoing through the crypto world. A quiet murmur that's grown into a roar. Where are we in the market cycle? To find an answer, we didn't just look at charts. We went directly to the source of the community itself. We ran a poll across X, Telegram, and Facebook, asking thousands of people a simple but profound question. What does the future of this market look like? The results were telling. The largest group, a clear majority, believes the bear market has already begun. They're battening down the hatches, preparing for a long, cold crypto winter. The next biggest faction believes the cycle is extending, pushing out to 2026. They see the road ahead as longer, but still leading upward. Trailing behind were the believers in the classic 4-year cycle and the eternal optimists hoping for a supercycle. What does this tell us? If the crowd is leaning bearish, a contrarian has to wonder if we're all looking in the wrong direction. History is littered with moments when the majority was proven spectacularly wrong. When everyone expects the ship to sink, sometimes it's just passing through a storm before finding clear skies. This sentiment, this collective feeling of impending doom, might be the most bullish signal of all. It suggests we're not at the end, but perhaps somewhere in the murky, confusing middle. Regardless of whether the cycle is for years, 10 years, or breaking its old patterns entirely, one thing remains constant: the importance of your own strategy. The market's rhythm is fascinating to debate, but what truly determines success or failure is your personal time horizon and the plan you stick to through thick and thin. The noise of daily price action can be deafening, but long-term investors learn to listen for a different frequency, the steady beat of their own conviction. Are you here for a season, or are you here for the long haul? The answer to that question matters more than any prediction about where the market is headed next. To understand where we might be, we need to understand the emotional journey every market takes. It's a classic story, a psychological roller coaster that repeats with uncanny precision. It begins with doubt. After a devastating crash, when portfolios are in ruins and hope is a distant memory, the first green shoots of recovery are met with skepticism. This can't be real, we tell ourselves. It's a dead cat bounce. But as prices slowly grind higher, doubt gives way to hope. Maybe, just maybe, the worst is over. Hope then blossoms into optimism. The market feels stronger, the narrative's more compelling. We start deploying more capital, feeling confident that we're getting in early. Optimism solidifies into belief. The trend is undeniable now. We're convinced we've made the right call, and we tell our friends about the incredible opportunities they're missing. Belief then ignites into thrill. Gains are accelerating. It feels easy, almost effortless. We feel like geniuses. And finally, thrill explodes into euphoria. This is the peak, the moment of maximum financial opportunity and, paradoxically, maximum risk. Everyone is a guru. People are quitting their jobs, taking out loans, and boasting about their life-changing gains on social media. The conviction that prices can only go up becomes an article of faith. Then, the cycle turns. Euphoria gives way to complacency. The market chops sideways, but no one is worried. It's just a healthy consolidation before the next leg up, we reason. But then, a sharp drop ignites anxiety. The first real crack in the facade appears. Is this the top? We start to question our positions. Anxiety deepens into denial as prices continue to fall. We hold on, refusing to believe the party is over. The fundamentals are still strong, we insist. Denial inevitably shatters, leading to panic. The sell-off is relentless. Everyone is rushing for the exits at once, trying to salvage what they can. Panic culminates in capitulation, as investors finally give up, selling their holdings at any price just to make the pain stop. This leads to the final stage, despair. The market is a wasteland. The dream is dead. But it is from this very bottom, this point of total disillusionment, that the seeds of doubt are sown, and the cycle begins anew. So where are we on this emotional map? If you listen to the poll, we're somewhere between anxiety and denial, staring into the abyss of panic. But look around you. Are your friends and family taking out mortgages to buy crypto? Are newsstands filled with magazine covers celebrating Bitcoin billionaires? Has the world reached that fever pitch of unadulterated greed we call euphoria? It doesn't feel like it. We've seen excitement, we've seen optimism, but the kind of world-altering, society-shifting mania that characterized past tops seems conspicuously absent. This suggests we may not be at the end of the journey. We may not even be close. Perhaps we are still in the belief phase, climbing the wall of worry on our way to the thrill that precedes the final, euphoric peak. This idea of cycles isn't unique to crypto. It's the heartbeat of all financial markets. For decades, the S&P 500 seemed to follow its own predictable rhythm, a 4-year cycle often tied to U.S. presidential terms. A new administration would come in, and the market would often experience a period of uncertainty, followed by a rally as new policies took shape. This pattern held for a long time, becoming a reliable tool for analysts and traders. But patterns, no matter how reliable, are not laws of nature. They are products of their time, shaped by a specific set of conditions. For crypto, the 4-year cycle has long been anchored to the Bitcoin halving, a programmed reduction in the supply of new coins that has historically kicked off a new bull run. This quadrennial event has been the market's metronome. But today, the orchestra has new players. The introduction of spot Bitcoin ETFs has brought in a tidal wave of institutional capital, fundamentally altering the market's structure. Unprecedented macroeconomic factors, from inflation to global interest rate policies, are exerting forces we've never seen before. These new dynamics are disrupting the old rhythm. The reliable beat of the halving is now competing with the loud, unpredictable noise of a globalized, institutionalized market. The old map may no longer describe the territory we're in. Ultimately, we are left with a powerful, if unsettling, conclusion. 4-year cycle will continue to exist right up until the moment it doesn't. We must not be dogmatic. We must not assume that the patterns of the past will hold forever, because the moment we do is the moment the market will find a new way to surprise us. We are likely entering a new regime, one that requires new thinking and a flexible approach. The old rules may not apply, and clinging to them could be the costliest mistake of all. So what is the right move? If you've already sold everything, convinced that a brutal bear market is upon us, you've made your bet. Your risk is not the crash you foresee, but the face-ripping, late-cycle blow-off top that you might miss. It's the pain of watching from the sidelines as the market soars to heights you never thought possible. On the other hand, if you're holding on with diamond hands, certain that we are in a prolonged cycle destined for 2026, you face a different risk. Your danger is a deep, protracted drawdown that tests your conviction and erodes your capital for months or even years. There is no single right answer. There is no crystal ball. There is only the strategy you choose and the risk you are willing to accept. Whether you believe the end is nigh or that the journey is just beginning, your survival depends on having a plan. Know your entry points, but more importantly, know your exit points. Manage your risk with the discipline of a soldier. Because in the end, navigating the market cycle isn't about being right. It's about being prepared for what happens if you're wrong. The market is a relentless teacher, and its most important lesson is this: adapt or be left behind.